Are you wondering how to get the most out of your stocks and shares ISA in 2025? Or perhaps you don't have one and you're wondering, what one is and why would you need one? Hopefully you've come to the right place. Before I start, I just want to show you some quite startling data on ISAs in the UK. I think it's quite eye-opening, some of this stuff, so it's quite interesting to see. This shows that about 12 million adults in the UK have got ISA accounts, but even less have got stocks and shares ISAs, so only 4 million of those are actually stocks and shares ISAs. The number of adults in the UK is 40 million, so only 10% of adults in the UK are making the use out of stocks and shares ISAs. I think that's absolutely criminal, but I don't think it's our fault. I think we're not taught, how important these things can be. So if you're one of the people who don't have a stocks and shares ISAs, it's not your fault. When we compare the amount of assets that are stored in cash ISAs versus stocks ISAs, taking into account that there's more than double the amount of cash ISAs than stocks and shares ISAs, I think it shows us that there's actually quite a big problem. The amount stored in cash ISAs is about 300 billion, but the amount stored in stocks and shares ISAs is 400 billion. So despite there being twice the number of cash ISA accounts, there's less money stored in them. So, but why? Why could that be? It could be that rich people use stocks and shares ISAs, but poor people use cash ISAs, and that would explain the difference. Or it could be that stocks and shares ISAs actually are a better vehicle to grow wealth and put yourself in a better financial position in the future. I know which one I would like to think it is. There's no solid data that I can find that explains why. If you put £100 a month into a global index fund within a stocks and shares ISA over the last 10 years, you'd have over £20,000 in there compared to just the £12,000 that you contributed. It's actually even worse if you just put a £12,000 lump sum in the ISA. But then if we extend these returns over the course of a working life, say 40 years, £100 a month, you'd actually have over £400,000 in that stocks and shares ISA, completely tax-free to withdraw to do what you want with. So if you're one of the 10% of UK adults who currently have a stocks and shares ISA, then brilliant, you're one step ahead of the game. But if you're one of the 90% that don't, then don't worry, it's not your fault. We're not taught this stuff from early on. Let's try and fix that. So where do I get a stocks and shares ISA then? I personally use Trading 212. You can go onto your app store, download the Trading 212 app and start investing on there. Trading 212 as a platform is completely free. There are no platform fees to pay at all. The only fees that you'll pay are on things like trading fees if you're doing individual stocks and the fund fee itself for a global index fund. But the first thing you might want to know is who Trading 212 are. You don't want to be depositing your hard-earned cash into some random company that you've never heard of. Well, Trading 212 actually founded in 2004, I believe, in Bulgaria. It might sound a little bit dodgy, but they do have a UK limited FCA authorised branch now. So they're completely protected by the Financial Compensation Scheme, the FSCS, and also under what's called the CAS rules, the Client Asset Source Book rules. So basically they have to hold your money separate to theirs just in case they go bump. They can't touch your money then. And you're also protected up to £85,000 if something goes wrong as well. At this point, it is quite important to note though that the losses due to your decisions investment-wise are not actually covered under the FSCS or the CAS rules. So Trading 212 offer a few different accounts. They offer a general investment account, what's called a CFD account, which is a contract for difference account. Now, Trading 212 themselves say that about 80% of people actually lose money when using this account, so it's not something that I would personally touch. They've got a stocks and shares account, which is the one we're going to be using, and they've also got a cash ISA account as well. It's worth noting as well that all these Trading 212 ISA accounts are completely flexible. You can withdraw them, you can withdraw money from them when and as you see fit, and you can deposit that again without using up extra bits of your allowance, which is also a really nice feature. As I mentioned earlier as well, that 4.9% is actually Trading 212's instant access cash ISA rate, which is pretty much the best you're going to get on the market right at the minute. To set up an account with them, you'll need a few personal details, your national insurance number, and they'll ask you a few questions as well. Now, it's quite important that you answer these questions thoughtfully and honestly. Don't try and skip through them just choosing random answers. Actually read them, have a think about them, and answer them completely honestly. Once your account's set up, you can deposit money either with instant bank transfer within the app or standing order through your own bank. You can try depositing £10, something like that, and then just try and withdraw it and just see how quickly it is to sort of get your money out if you need it, just to give you that little bit of reassurance before you start depositing larger amounts. What I normally do is I've got a standing order set up with my bank. The money goes in straight after I get paid, and then you can also set it up to be automatically invested within Trading 212. You've also then got to enter your own bank details on Trading 212 just so that they can link that incoming money to your account. Now the next question then, once the money's actually in Trading 212, is what do you actually invest in? Which stocks do you buy? It can all be quite overwhelming. The first page shows you funds and pies and various different stocks, and it can kind of be a bit complicated, but it doesn't need to be. Now, before I start with this, I'm not a financial advisor, so ultimately you're going to have to make the decision as to what to invest in. But I can tell you what I invest in and sort of my reasoning behind it, and you can see if you agree or not. Now, in my opinion, you can't go wrong with a global index fund. They're passive investments, which means they effectively manage themselves. You're not paying a fund manager to manage the fund for you. They contain thousands of companies from all over the world, which means you're diversified. So what you're essentially doing is you're buying little bits of these, all these companies, these thousands of companies, and it enables you to take part in the profits that they make. They'll pay you a share of the profits that they make, and you'll see that in the form of the returns that you get in your account. There are a couple of caveats when you start investing into equities, which is what a global index fund is. You've got to have a long time horizon. There's no point investing in there for a week or a month or even a year sometimes. It's quite a volatile market. The market will go up and down, but it'll trundle upwards over time. The best analogy for this, and unfortunately I can't take credit for this, is if you look or think about a person with a yo-yo riding up an escalator. While the yo-yo goes up and down quite a lot, the escalator trundles upwards. This is basically the global stock market. Over a short period of time, the value could drop 20-30% in the space of weeks. But you need to ignore that, and you need to concentrate on the escalator. The escalator will trundle upwards over time and give you inflation-beating returns over your working life. For example, if you take the S&P 500 index, which is the top 500 companies in the United States, if you look at 1 year periods, it's something around 70% of 1 year periods will actually have made you money. 30% you will have lost. Increase it to 3 years, that rises to somewhere above 80%. And then you increase it to 10 years and it goes up above 90%. So the longer you can keep your money in without fiddling with it, the better you'll do. Now, another reason to be invested over this long period of time is to take advantage of compounding. Now, compounding is something that's briefly taught in GCSE maths at high school, and I can bet that most of you didn't even pay attention to it because we never realised how important it was at the time. The effect that compounding has on your investment is huge. Let's say you invested £100 in a savings account earning 10% interest. Then at the end of that year, you'd have £110. You've made £10 in interest. But now you've got £110 in the same account, still earning 10% interest. So in a year's time, all of a sudden, instead of it making £10, you've made £11. 10% of 110 is 11. So you've got £121 now. This process keeps repeating over the course of your life. So over 40 years, the effect it has on the total value at the end is massive. So in terms of investing, the sooner you start, the more time you give compounding to make you massive returns. If you're 18, 19, 20, and you're learning about this already, you are in such a good position. You've got potentially 45 years, 50 years before you retire. The gains that you could make in that time just from compound interest are huge. In 50 years' time, you'll get to retirement, and the vast majority of the money in your retirement pot you won't have even contributed to. It will all come from compound interest. But in order to take advantage of that, you've got to be investing, and you've got to have a tax wrapper around it to protect it from the tax man. This is why a stocks and shares ISA is so important. Another point is you can't fiddle with it. So there's a lot of talk at the minute that there might be this huge stock market bubble, and we're going to have a huge crash, and you're going to lose 50% of your money. But they've been talking about this for 2 years. 2 years ago, I was talking with some of my good friends, and one of them said to me, yeah, but the S&P 500 is at an all-time high, so you don't want to invest in it right now because it's just about to correct itself. Now, if I had listened to him, I'd have missed out on 2 years of exceptional gains. You cannot time the market. You have to be in it for the long run. There's another saying that goes, time in the market isn't important, it's time in the market. And that can't be overstated. You need to keep your money in there and forget about it. Now, I mentioned global index funds, but there's quite a few of them actually. So which one do you invest in? Now, I don't really think it matters all that much as long as you're in a global equity fund. I don't think you can go far wrong. A few of them are like VHVG, that's the FTSE Developed World Index by Vanguard. VWRL's FTSE All World, I believe that's also by Vanguard. Now, they have slightly different fees, slightly different compositions. Developed World is obviously just developed markets. All World includes emerging markets as well. Again, it doesn't really matter which one you choose. You're in a global index fund, you're going to make gains as the global stock market increases in value over time anyway. But you can search these funds using the little search bar, and then if you scroll down on that page, you can find a fund fact sheet just here. It's worth having a look at. The fees are slightly different. A lot of the times, the stuff in them's relatively similar if it's a global index fund. Now, one thing you might have noticed when you start searching for fund is there's some that say ACC, ACC, and some that say DIST, DIST, and you might be wondering what the difference is. So the ACC is an accumulating version of the fund. So basically all that means is that any dividends that are paid by companies in the fund are automatically reinvested. You won't see them, it'll go straight back into the fund and be reinvested. With the distributing, you'll see the cash in your Trading 212 brokerage account. And it's important to note that if you don't reinvest it, you will see less returns. This is why I personally go with an accumulating fund. You don't have to think about reinvesting the returns of the fund, and you can be sure to maximise your gains. If you're one of the type of people who likes seeing that cash payment into your Trading 212 account, then yeah, fair enough. You can go with distributing, I get it. Now, I did mention fees briefly there. Now, fees is quite important because what people normally sort of realise about fees is that it's going to cost them a little bit of money to be invested, but normally what they don't realise is that fees actually reverse compound. So if you have a high fee over the course of, say, 40 years, your working life, you can actually reduce the total value of your pot at retirement by 25, sometimes 30% with the really high advisor fees. So it's quite important to choose a low fee global index fund in order to reduce the amount of money that you're paying to these advisors. And these advisors anyway, there's a shocking statistic that something like 95% of these managed fund advisors actually underperform the market anyway. So you're paying them an absolute fortune to get less returns. It doesn't make sense to me. Why not just buy the global index fund? You're buying the world anyway, you're going to reap the rewards of the global stock market without the fees. Most of the passive global index funds have low fees anyway, so it's not really something that you should be massively worried about when buying a global index fund. I should also quickly mention here that if you're sort of coming up to retirement, paying a financial planner is a little bit different to sort of paying for one of these managed funds, because a financial planner could actually give you quite a bit of value when you're coming up to retirement. The last thing I want to talk about here is risk. Now, the first thing that your family and friends might say to you if you tell them that you're investing in the global stock market is, oh, well, just be careful because you can actually lose all your money. And while this is technically true, I think this is a fundamental misunderstanding of the global stock market. The same people will probably say that keeping cash in an account with your bank is completely risk-free, but I don't agree with that. With the cash sat there in your building society or bank account, inflation is slowly eating away at it. So say you have £10 in your bank account, you can perhaps buy 10 Greggs sausage rolls today at £1 each, but tomorrow they've put the price up to £1.05p. Now you can only buy 9. Inflation's eating away at the value of your money, and although you've still got the same amount, you can't buy as much with it. Whereas if you'd had that £10 in the stock market in a global index fund, it could be worth £15, and then all of a sudden you can buy 14 sausage rolls instead of 10. So hopefully it's given you a bit of an insight into stocks and shares ISAs and how to invest in the global stock market. I think the main takeaways from the video is to just invest passively into global index funds. You track the market. You'll beat 95% of professional investors who are trying to beat the market. Yeah, okay, 5% will beat the market, but I'll take the increased odds. Just remember, it's going to be a slow process, but you'll come out of the other side of it in 20 or 30 years' time, and you'll be really glad that you did it. You just have to stick it out for the long run.